There's this phrase I keep coming back to, and it's that money follows trust. Not credentials, not pitch perfect decks. It's not traction, at least not at first. And trust is just another word for reputation. Today's guest is someone who has built his entire career on that premise, except he's doing it from the other side of the table as a venture capital investor. His job is to look for a founder, often before they have a product, before they have revenue, before they even have a co-founder sometimes, and decide, do I trust this person enough to bet on them? Justin Kang is the co-founder and general partner at Visible Hands, a pre-seed fund based right here in Boston that backs what they call overlooked but formidable founders, women, founders of color, and the builders the broader VC world keeps sleeping on. Here's what I find fascinating about Justin. His path to VC wasn't through finance or startup founding. It came through civic leadership, running economic growth initiatives for the Greater Boston Chamber of Commerce, leading City Awake, pushing for racial equity and talent attraction across the region. He's a community builder at first who became a capital allocator second, and that's not a coincidence. And since Visible Hands is a pre-seed fund, the model is simple. They invest in the person before they invest in the product, which means the question they're asking every single time is, who are you and why should I trust you? Which gets me very excited because this is all about reputation building and trust building. This is Return on Reputation. I hope you enjoyed today's show. All right, Justin, welcome to Return on Reputation. I want to start at the beginning because your path is really not the typical VC origin story, or at least I don't think so.
Sure.
And you and I go back way long ago, so it's awesome to see you again. But I think the story matters a lot, and just as a background to this conversation. So let's start there, because you didn't come through investment banking or a big fund.
Thank goodness. Yeah.
Yeah, you came through a lot, what I would say like civic leadership, the Chamber of Commerce, City Awake.
Yeah.
Walk me through that journey.
Yeah. I think I, like any other good millennial, my 20s, well, yesterday someone thought I was 26, but I'm actually 39. But in my 20s,
That's a nice compliment.
Yeah, I'll take that. So, I spent most of my career sort of being like any good millennial, hopping around every 2 years from politics to policy, nonprofits to startups to entrepreneurship support organizations. I was lucky enough to be one of the early employees at Mass Challenge and such. But you're right. There was no way that any VC fund would have hired me. I think the only way that I would have ended up in VC would have been just starting my own VC fund. But while my resume or LinkedIn might not seem like, oh, this is a classic VC kind of thing, and that might be true. I think if I was like a later stage investor, like Series A, Series B, or beyond, like I don't think my skill set, especially with that being much more skill sets around modeling and finances, that I would have been the right person for that. But that's at the earliest stage around pre-seed, which is really about finding the right founder, finding the jockey and the horse that you want to bet on. So, how I got into this, I've always been adjacent to the VC industry, whether it's working in a tech startup or an accelerator, or even at my role when I was at the Chamber as the VP of Economic Growth. I oversaw a number of initiatives, one of them sort of focusing around how do we build wealth for people of color and women and other underrepresented groups through the private sector. I loved my job at the Chamber, but at some point I wanted to narrow in on a specific problem statement versus working on like everything under the sun. And for all its ills, venture capital has tremendous wealth creation potential. Unlike, let's say, real estate or buying stocks, you need money to do those things. So, for myself, we wanted to help people build companies and have huge liquidity events to build a new generation of wealth for a lot of marginalized people. So in 2020, me and two friends started Visible Hands, and it's been the best journey so far.
I'm impressed that you guys just started a VC fund, because to me on the outside, and I've been in small business and startup culture for a long time, like the thought of doing that is kind of gargantuan, right? Like it's like,
I don't know that. Yeah.
So kudos to you guys. You started summer 2020, right? You launched then. Why then? Why was it your co-founders, Daniel and Yasmin?
Yeah, we've been ideating this since 2019. took the leap of faith in April or May to leave the chamber. Now,
Okay.
coincidentally, around that same time, COVID happened. Oh, and yeah, but I already gave my notice, and we had a transition plan, and was ready to make that leap. Fortunately, the stock market did well, so we didn't pay ourselves for a year.
Okay.
Um, Now, the other major societal event was the murder of George Floyd, uh,
Yep.
and bless him, bless his family. And, it's our privilege to make sure we honor him and his legacy well, because if it wasn't for him, so many of, I don't think we would exist. I don't think a lot of our peers who also operate VC funds with equity as a focus would exist. But that gave a lot of motivation and inspiration for people to, put their money where their mouth is. And we 70,
Mhm.
80 LPs, limited partners, investors into our fund come together to help close our first fund around $10.5 million. So we're very blessed to be in that
Awesome.
situation.
That's great. And the company name, you guys, or the fund's name, Visible Hands, a lot of work there. What does that mean to you personally? Just,
Yeah, it's a play on Adam Smith. If you're like
oh
an
yeah.
economic nerd, on the theory of
Yep.
the invisible hand, which simplistically says like just let the market dictate; it will just sort of naturally work itself out.
Yeah, oh, okay.
Um,
Cool.
we not fully disagree with that, but we also believe like we need to have active interventions, visible and hands, and plurality of there, not just one hand, but hands of like a community to help support entrepreneurs in their journey. And that's
Mhm.
where we sort of landed on that name. So,
Got it.
it's a weird name for a VC, but it works for us.
And it sounds like you bake that right into your model because, similar to Mass Challenge, you have a lot of programs for founders
Yeah.
to get experience and come through. I think that makes you guys pretty unique from a venture standpoint.
1,000%. For ourselves, we look at everything as deal flow. So it's not just a
Uh,
charitable side of us, but we believe building up ecosystems in specific geographies, New York, Boston, and the South is where we're focused on. It allows us to get to know the founders. It helps us elevate our brand and also
mm,
as many people as possible from the impact orientation. But, just because you have money doesn't mean that founders will come to you. Like they need to know to come look for you, right? So,
yeah.
um, we look at our programs and events and initiatives as a way to build up deal flow for us.
Makes sense. Right. So, and I'm sure it's incredibly successful for that purpose.
Yeah.
It sounds the mission of building up the local economies in those cities you mentioned is very similar to way back. I'm dating, this is years ago, Mayor Menino,
Mm.
Boston's mayor at the time. He started Boston World Partnerships. I don't know
Yeah.
if you
Yeah.
remember that.
Yeah.
So very cool. I love that mission. I didn't actually know that. So that's great. And then so as you're looking to deploy the capital. And, you talk about, people who are, I don't know, I don't know, do you say the word disadvantaged?
I would say underrepresented, disadvantaged,
Underrepresented. Okay.
but yeah, many different ways. Yeah.
Yeah. And you've talked publicly about like AAPI identity
Hmm.
as part of your investing mission.
Yeah. Yeah.
Can you unpack that a little bit and, so listeners can understand
Yeah.
how that shapes, different bets you make?
Yeah. I mean, for us, ultimately, and we look at underrepresented in many different categories, whether it's race or gender or even geography. Like
Mm.
a
Hmm.
super majority of VC dollars only goes to New York, Massachusetts, and California. And
Oh, wow.
I spent most of my career in Massachusetts, and I live in New York now. So I both places I love. But with that being said, there's probably many more talented people. Like all the talented people don't live in just three states, right? But the issue just comes down to like
Right.
access to capital. So we think about it from race, gender, geography, sexual orientation, veteran status, disability. And what we learned is that, VC is a very relationship business. And not surprisingly, a lot of VCs have networks that are exclusive in that way. It's their alma mater, whether typically it's Stanford or Harvard or MIT, and they're just going to get deal flow that is warm to them. And that strategy works a good amount of time. We just have a fundamental belief that there's talent everywhere, and what they're lacking is that initial resources to get them going. And that's why we are really primarily passionately pre-seed. We want to be the first institutional or one of the first institutional investors cutting checks of, a few $100,000 to to get people going.
Yeah. But I would imagine pre-seed is a riskier bet.
Yeah. Yeah.
How,
So, yeah.
and is that partially, so are you kind of, because it's riskier, obviously it's a numbers game. If you know anything about venture, you know that.
Yeah.
But to mitigate that risk, is that also why you guys are hands-on with founders and like trying to help them as much as possible?
Yeah, absolutely. Great point. Statistically, actually, like micro funds are actually outperform like the mega funds.
Right.
Why we don't see that many micro funds out there is because the business model for a micro fund doesn't make sense, because for those unfamiliar, VCs get paid through management fees, typically 2%. So if you have a $10 million fund or a $20 million fund, that's like $200,000 to $400,000, which might sound like a lot to the everyday American, but to run a VC fund, that's way
So
not
much.
sufficient, right? So it's not a rich person's game when it comes to running a micro fund, but they do outperform.
Okay.
We've been lucky enough because we also have sort of an adjacent business. I referenced the regional ecosystem building things that we do. We essentially get paid to source, where we partner with cities, corporations, and foundations in the New York and Boston and in the South, where we generate about $3 million annually, right? So we actually have the resources of a big fund, but we can still be focused as a micro fund. But as you said, now that we have these resources, we can have a much larger staff and other resources to support the founders at the earliest stage, allowing us to provide that hands-on support. So that's one of our benefits of sort of how we operate.
So government funds are helping pay. Did I get that right?
Yeah. So, quasi. So, for example, we're proud partners with the City of New York and their Economic Development Corporation. So,
Okay.
it's I don't know if it's exactly a quasi or a separate entity, but they're associated with the City of New York, and they work on building a thriving, inclusive New York City economy. And we have partnerships with them. We have partnerships with them to run an accelerator, as well as create a central alumni network for various accelerators in New York City. So we get access to a bunch of the alumni of 10, 15 accelerators now. So yeah, so that all works out, and those contracts allows us to have a staff to service those programs, but also work with our founders in general.
Right. Well, that's really interesting. That's a really smart model, because they're incentivized to make their city, the geography, flourish
as flourish as possible. Yeah.
So they're using you as the tool to make that happen. And it's great. Very, very cool.
In the South, we work with a family office that's very focused on Southern economic development. And then in Boston, we work with some of the largest foundations who are similar interests.
And so obviously this is very unique to venture. It's the first I've heard of it. Do you credit like your background, as we've talked about earlier, like coming up, was that a different frame that you had?
Yeah, sort of just natural, right? Like, it wasn't intentional, but it's sort of, we just naturally gravitate toward this model just because, not only my background, but my co-founders, we all sort of have interdisciplinary backgrounds. Like my co-founder went to Kennedy School, as well as, his MBA at Wharton, and he worked in the private sector at Summit Partners and Goldman Sachs, but also has served on number of national nonprofit boards. And my other co-founder, Yasmin, similarly worked in, CSR, but also in private wealth management. So, I think the uniqueness of us as three founders is that we understand business, but also understand economic development. And that sort of just naturally became our sort of positioning as a fund.
Yeah, it's a big mission. It's very cool.
You got cross fingers, yeah.
And okay, so I'm going to go a different direction here, but you guys, you said you're pre-seed.
Yes.
It's very different from, series C, D, E, whatever. You're making bets, I would imagine, on mostly the founder. I'm guessing.
I mean, that's paramount. Yeah. We have, unlike other pre-seed funds, and there's no bad or good here, it's just the way we do things. But a lot of pre-seed funds, I think, make decisions faster. We like to get to know the founder. Our diligence process is a bit longer, probably like 4 to 6 weeks typically. And it's because for us, like, this is how I want to build wealth, right? And my co-founders do as well. So we want to be certain about our bets as much as possible, even with the limited data, because, so we look at the founder for sure. We look at the market. But the third one that I think is the hardest thing to crack for a lot of our companies we source is the growth assessment, right? So for us as investors, we go through an exercise called the Series A Readiness Workshop, where we work with
Okay.
the company we're diligencing, and we craft 3 success statements asking like what needs to be true for you to achieve a Series A. And then we sort of workshop backwards, being like, can you hit these AR goals or these usage goals or this product goals, right? By a 3-4 year time frame. And for us, why that's important for people unfamiliar with VC is that the average now company takes like 12 to 15 years to go IPO. Like for us, we
Okay.
can't wait that long, right? So for us, we want the companies to hit Series A, Series B, Series C. And for those unfamiliar with the secondaries market, then we can sell off our positions at Series A, Series B, Series C 5-7 years out so that we can have liquidity versus waiting 10 plus years, right?
Got it. Okay. But what are you looking for? So say if I'm a founder coming to you,
Yeah.
right? What weights are you looking at to kind of grade me as a founder? Is it like my reputation
Yeah.
as a leader, or like my past, I guess, like, give me a scale for like
Yeah.
each category, because I'm imagining it's going to be like, if I've been successful before, odds are maybe that I'm going to be successful again. So like my deal flow, my reputation there,
Yeah.
is it like brand equity that I have? If I have 1 million followers, is that cool?
Yeah.
And then I've got a great team, or is it the idea itself? Because there's probably not much product. You guys are pre-seed, so what's proven out already in terms of like run rates and return, revenue.
Yeah, we will, we're open to investing in like idea stage companies. Typically, they do have some level of traction in early revenue. So our most recent investment, they had 50 SMB customers, small revenue numbers, but they showed that they had a die-hard customer base, right? So we were like, okay, they got 50 people loving their product, which is probably their ugliest version of their product that they'll ever have. Like that
Okay.
shows to us that there's a pain point here, right? Now, but you're right. It comes down to the founder as like the one of the most important things. We look at things like inspired insights. We care less about the ideas because 9 out of 10 times the company's going to pivot from their initial concept.
Yeah.
Um, so we care about like, do they have compelling insights or a point of view of the problem statement versus like the quality of that idea. We like to evaluate meaningful skill sets. So no shade to management consultants, but like I want people who can actually contribute to the business versus just writing strategy docs and decks, right? So we want people who are actually actively working on
You got
it.
to execute.
You got to do something, right? And I've seen founders and people who struggle with actually executing versus strategizing, right?
Yeah.
And again, there's plenty of good management consultants who became entrepreneurs, but we look at something called resource magnetism. So do you have the ability to be a magnet towards resources, whether that's capital, customers, talent? Because like when you basically probably have $0 or next to nothing and you have a very ugly product, can you get people to champion you regardless, right? So
Yeah.
we have a
Yeah.
number of attributes like that we look for in qualities of founders that we sort of codified over the last few years.
Yeah. That's really cool. I would imagine, I mean, charisma and sales,
Yeah.
like at least in one of the team members, has got to be there.
Yeah, your point being is like, and people underestimate go to market. Like, we want people who understand how they're going to sell, how they're going to get to the customers, what's the value prop. And, there's a cliche saying that's, I think, usually true, which is like first time founders focus on, product, and second time founders focus on like making money, right?
It makes things a lot easier when you're making money.
Yeah, and then you actually have a business too, right? So you don't have to like try to figure out how to get VC funding. Or also, if you want VC funding, the best way to convince a VC is like making money. So that's what we
Sounds
look for. Yeah.
shocking.
Mind blown. Yeah, exactly.
Incredible.
Yeah. Yeah.
Yeah. Well, I think I've talked about this a lot. Like the media will, they hype up these stories, Facebook and
Dangerous. Yeah.
yeah. And people feed into that. And you're like, well, I raise money so we don't have to make money for a few years. And I've never understood that.
Dangerous. I love that we have a more entrepreneurial society, not to, age us, but like, I think when we were like getting into the professional world, people wanted to be bankers or management consultants or lawyers, like all that people want to be entrepreneurs. At the same side, it sucks that people think the only way to be an entrepreneur is raising the most money instead of like thinking about building an actual business that actually generates revenue.
Yeah.
We tell our founders is like, you know, build a business so that VCs chase you versus you chasing them, right? Um,
Hmm.
and that's been sort of paramount there. So yeah,
Yeah. No, it's something. So when I started, I actually went into banking right out of college, and then I couldn't do it. And so I took a,
still don't know
you
what
know,
bankers do. So, but I respect them. So yeah,
it was a commercial real estate lending, to be very specific.
okay, yeah,
And, we were managing, huge construction loans, and
yeah,
it was fun,
yeah,
but, not what I wanted to do. It felt kind of handy, kind of handcuffed. And so I started Social Boston Sports, and we never raised money. We started with $5,000,
yeah. I love
and
it.
it was frustrating because at the same time, Facebook, and now Meta, was coming up, and, we grew with that. And you hear these incredible stories, and they raised all this money. They didn't have to worry about the actual business, numbers. It was just like, this is going to be a unicorn from day one. And obviously it is. And I was like, we have to actually worry about, you know, LTV and profit margins, and like, how can we grow? Can we afford to hire one more person today? Or all
Yeah.
these, very interesting things. So, but
There's a beauty in bootstrapping or having limited resources because it helps you prioritize and create.
yes.
And not weirdly enough, like some of our companies that raised a lot of money pretty quickly with unknown track or like not definitive like validation,
Yeah.
they raised money and we those were our trophy investments, but a number of them have shut down. And some of our
Mhm.
best companies are the ones that raised the least amount of money or no money, but had to be so resourceful and so focused. And it helps you prioritize, which is a good
Yeah.
exercise. And the beautiful thing now, AI is terrifying, but it's probably not a valid rationale to being like, I just need more money to do A, B, C, or D. Like you can
Mhm.
build enough traction with the tools out there to test out your assumptions to then raise venture. So that's one of the benefits of AI right now.
Yeah, AI is insane. We're building a business right now, and I feel like not only do I have to build the business, but I also have to keep up with AI. You're playing two games.
Yeah, exactly. Yep.
Every day is, a few hours into it, and we've been in it, since ChatGPT launched in 2022.
Yeah.
I was like, this is the next wave. It has to happen. Are
Yeah.
you Couple questions there. Are you seeing companies come to you with smaller team and needing fewer resources because of AI?
Yeah, for sure.
Yeah.
Yeah. 1000%. Yeah.
And I would imagine, like, on top of that, I would imagine you can say like, hey, I'm going to give you less money because you should be more resourceful with it.
Yeah.
I don't know.
Yeah,
You're
more
great.
so. Yeah, we determine check size basically on trying to achieve our ownership goals. So,
Okay. Got it.
um,
Makes sense.
yeah, so we want to make sure we at least hit 5. That's like the lowest we want to go to, and obviously I want like 10, like more. But yeah, that's how. Yeah, yeah.
All right. So the show is called Return on Reputation. Have you ever encountered a deal that was attractive in idea, but then was risky on paper because of founder reputation?
Oh, that the founder had a bad reputation.
Yeah. You're
Uh,
like, this is a non-starter. We can't do it, right? The idea is fantastic. Some of the team is good, but we don't like someone on the team, or
yeah.
they're a risk. Like,
No, we haven't been in that situation, but those merits are super important because fund one, we made 100 plus investments. Fund two, are making it more concentrated with 20. Now, with fund one, we made much quicker investment decisions
okay,
because it was smaller checks and higher volume. This one, fund two, is bigger checks, lower volume. And I think what you're saying is very helpful and true because like we didn't get to know the founders as much as we probably should have in like fund one investments. Now, like I mentioned, it's like we don't want to make snap decisions. Like we want to take our time
right.
to your very point, because you imagine if someone's pitching you, they're pitching the best version of themselves. Like they should be charming or compelling when they're, walking you through a slide deck. what we try to optimize for is to actually get to know the founder, see them in weak moments or decision making moments to see who they actually are and how they react. Because to your point, there are things that we knew about certain founders in Fund One, maybe we wouldn't have invested, but we eventually learned of those things later on that might have been more yellow flags or red flags and entered that investment.
That's interesting. Yeah, I like that a lot. And you've talked about networking. I was doing some prep. I saw you on another show, and you call it, making friends. Like the best way to network is making friends.
Yeah. Yeah.
What
Yeah.
is that? Just like a long-term play? Like how do you like dive into that a little bit? Just like,
Yeah.
how do you approach that?
Yeah, I don't
What
know.
does
I've
that mean?
been saying that obnoxious phrase for like over a decade. The best way to network is to make friends. I think people over engineer like
Yeah.
professionally about like, how do I get to this space or that place, and like set me up on this coffee informational interview and all these types of things. I love what you're doing with the return on reputation, because that's, I have plenty of critics, but I think my reputation also has allowed me to do the work that I've done and succeed, because I look at people.
Yeah.
We look at founders as whole people. I look at my partners as whole people. I get to know them. Yasmin, who's one of my co-founders, was one of my initial funders for one of my startups back in the day.
Okay.
And then eventually we became friends, and I got invited to her wedding. And she was one of the first people, as me and Daniel started to conceptualize Visible Hands. Right. And, I think simplicity, like, you just can't predict how relationships are going to help you in the future. Right. So it's about like, can you give, can you support, can you be there for people? And by all means, people will come to you when you might need them. So I always tell people we were privileged enough to raise a fund one with, maybe not the most obvious track record to create a fund. But the only reason why we were able to do that is because, like, maybe we weren't the most qualified to raise a fund, but we had maybe the most compelling reputations, because myself and Yasmin and
Yeah.
Daniel are similar. We just built up great relationships and community and networks over our 10, 15 years of work experience. And before that, some people have known Yas since like when she was like a teenager, right? And
Mm-hmm.
people want to bet on people that they like and support and respect. And that's why we were able to get dozens of people to contribute to our fund. And then there were countless people who supported us non-monetarily to get Visible Hands off the ground.
Yeah, there's never, every success story. There's never it's never a story of one. And what you're saying to me is just it's leverage, right? So your reputation, all three of you were able to leverage that into building Visible Hands.
Yeah.
Quicker, and not to say you couldn't have done it.
Yeah.
Maybe, but it would have been much harder.
Yeah.
That's what I'm calling authority capital, right? So it's like it's brand building for yourself, but you always own it.
Gonna take that. Yeah, I like it. Because it's, to the point of authority, it's just, how do you make people feel? I think it's just like a fundamental rule of thumb. It's not what you do or whatever. It's just like, how do you make that person feel?
Yes.
When we, the same thing with our founders, we see them, we say we want to see founders as whole people, right? And our NPS is 92 with founders. And, I'm sure, and we get so many founders coming to us because they knew another founder who went through one of our experiences or as an investment. And we just have that trust and credibility. So it's so important in this day and age, especially when you're looking at like AI. Basically anyone can do the same thing from a product experience sometimes. Like, it's about your execution, and your execution is only going to be that much more successful with a strong foundation, a strong reputation.
Yes. Yeah. Do you think AI is now pushing people to be more human? Because you already said it, people want to buy from, people they know, like, and trust.
Yeah. I hope
There's
so.
a lot of, AI slop out there, and people are taking shortcuts, and it's getting noisy.
Yeah, it's a great point. Like, I can speak personally. It's like I deactivated Instagram and TikTok, 6 months ago, just because the feeds were just dumb. Like, I really need to see another like baby fashion walk runway thing of them dressed in fruit costumes, So definitely horrible, but like it just makes me dumber if that's just what people are pushing.
It's a time suck.
Yeah, time suck, and it just rots your brain. So
it's huge.
Yeah. So yeah, good point there for
Well,
sure.
especially where it's not even social media anymore. It's interest media, right? Like you can have 0 followers now and you're going to get tons of content flooding your feed.
Yeah, for sure.
Yeah, and that's a whole different conversation, I'm sure. All right, so what do founders get wrong?
Yeah.
Overall, I'm sure you've seen your fair share of pitch decks,
Yeah.
and you've written publicly about the importance of investing in your own brand early when you guys were raising Fund One. I think you said you had to do like 100 versions of the pitch deck.
Yeah. Yeah.
How did you figure out, as a fund, and then, how much of that was like brand work?
Yeah. And brand, I'm sure, people think brand is like often associate visual brand as the only thing that like what brand is not just your visual identity, right? And
No. That's a small piece of it.
it's
Yeah.
a piece of it. Yeah. I think the thing to elevate when you're brand building is differentiation and clearly
Mhm.
articulating that, right? And for us, I think, we did invest in like a strong visual identity and making sure that our pitch decks were polished versus like, yeah, I mean, people eat with their eyes, right? So like making sure, so that
Sure.
visual stuff is important, but I think what we've nailed over the years is the differentiation part, right? Like, even from the very beginning, like I made a point to say like, yes, we're, micro funds outperform, but they don't have the resources to support their founders. We found a business model hack that allows us to stay focused as a pre-seed fund and also service our founders like a mega fund, right?
Yeah.
And I think like that has resonated with a lot of people because it shows like, oh, you're different because of, a clear reason of your differentiation. That's going to be even more important because in this AI boom, so many people can, again, unless you're like a model company or a deep AI company, like you cookie cutter build up whatever type situation. So being able to communicate what your advantage is or your differentiation
Yeah.
is even harder when anyone can replicate your product very quickly. And I guess to your point, and and sort of what you stand by is this authority capital to being like, why are you this person to build it? So are you individually the differentiation? Is your network the differentiation? That's always going to be even more important these days.
Yeah. Or is it the process or
Yeah,
yeah,
for sure.
totally. Is there a version that's too polished? Like, do you
What do you
believe
mean
in,
by
like, I think Facebook, I don't know why I keep bringing up Facebook, but their whole thing is like
that?
move fast and break things.
Yeah.
Yeah. Do you believe in, I mean, at what point is it too manufactured? Is it too polished?
I don't know. I don't know. I mean, if it's polished, I'm like, sign me up. So now, if the person comes off, like if the individual comes off as too polished or disingenuous, no,
Yeah.
that would be a yellow flag for sure, right? And that goes back to the per thing. It's like don't over like if you're talking to VCs, like be your authentic self, right? Because like
Mm.
position, like you can. I think it's often obvious when people are being disingenuous in ways.
Yeah. But I think, all right. So just real quick there, be your authentic self. Does that mean I get to show up in like sweatpants and a sweatsuit? Like, if that's me?
Yeah, strategically,
Like, how
I
much?
think I mean, there was that scene in Facebook where the guy came in a robe or something, right? So in the social network. But no, to your point, like within parameters in that way for sure,
Yeah.
right? But even disingenuous, like I've seen founders like inflate their revenue targets because that's what they think VCs need to see, right?
Well,
Being,
it's dangerous.
we're gonna hit $10 million next year when we only did 100K last year, right? And you
Yeah.
know, maybe it's not intentional, but that's unless it's defensible, it's going to come off as misleading or whatever, right? So that might be too polished and like, okay, they're trying to align with the VC goals, but it's going to come off as disingenuous or misleading when I see it in that way.
Yeah, that makes sense. Yep. All right, and then as once you've made the investment, right? So you're a pre-seed, you make the investment, and now you're hoping that there's follow-on, right? There's, um, well, they get to seed. They want to get to. You want to get to. I can't talk. They get to seed A or
Yeah.
A seed.
Yeah.
Another round, right? Around A, B, C, and at some point you bounce. But how much of the founder's personal brand is part of that follow-on?
Oh, I mean, it's like, I think it's
Or is
Series,
it?
yeah, Series A, I think it's when you start to like There's the term founder-led sales. I think pre-seed and seed, like you maybe hire like an AE or like a SDR or
Hmm.
whatever, but it's still going to be very founder-led, whether from the product or the go-to-market. I think Series A is when you probably start to, because seed, pre-seed, it's about like, okay, there's something a little bit here, and then seed's like, okay, it's replicable, and then Series A is like, okay, let's scale this, right? And I think at Series A is when you sort of
Yeah.
move away from that. But a lot of that, like the founder is going to be essentially the manifestation of that company, right? To customers, to the community. And you made the point earlier about like if they have million, like people who have built-in audiences matter, right?
Yeah.
Because that's just what's going to be helpful.
They're more of leverage. They can move faster. They
Yeah,
have the
yeah,
reputation
the reputation.
there.
Yeah. So it's like if I worked in like an insurance company and now I'm working on an insurance tech company, it's just like, oh, you're more credible because of your expertise. And then I'm sure you have various relationships from your previous roles.
You're right. Yeah. All right, so let's dive into the weeds a little bit and get tactical because I think there's a real framework buried in how you evaluate founders. And so
Yeah.
just like as people are listening, they're like, I want to start a business. I need money to make this happen.
Yeah.
And they're building towards a raise or they're thinking about, how they show up online and in the community.
Yeah.
If you were coaching a first-time founder who's like a year away from raising pre-seed round, what
Yeah.
would you be telling them to do right now?
I think,
Specifically, like how they show up publicly, I guess.
yeah.
Does that matter? How are you seeing that?
Yeah, it's interesting because, I think I've worked hard on my community and relationships, but interestingly enough, like I have no social media, I have no LinkedIn post. My team teases me about my privacy and secret, sort of, secretiveness and all that stuff.
I'm surprised I got you on the show.
Yeah. So, but yeah, but I enjoy building the relationships, right? So I think in terms of what you're asking is like figure out what form factor works for you, right?
Yeah.
And to build up that authority capital, like, okay, maybe it's like a volume game. So you put it out to, and that's what good social media channels are, right? Because there's a beauty in like you don't know who might see what you post and start following you and then build up interest and like all that stuff. So that's super helpful in that. For me, I'm more comfortable in terms of building relationships, one-on-one relationships, right? And then I hopefully can leverage that of some value in the future, and if it doesn't, but I think trying to figure out what makes sense for you. Not everyone needs to be a quote unquote social media influencer. And maybe it's
Yeah.
not social media, maybe it's Substack, or maybe it's podcast or whatever. Maybe it's just trying to hit up speaking engagements. But what I think is appreciative, especially a year before, is at the very least, like putting yourself out there is super scary. And actually, to connect the dots for me, I procrastinated for weeks because I kind of underestimated my community. For a few weeks, I
Mm.
left a job and I didn't really tell anybody. And I was like, just sitting on my hands, being like a management consultant and just like, what can I do next? And finally, I sent out like 100 emails and I set up like 100 meetings and I just told everyone what I was working on with Visible Hands.
Yeah.
And not surprisingly, people showed up, supported in many different ways. But even though like I'm most comfortable in relationship building, it took me a while to feel comfortable to put myself out there. So I think
Mm.
from a hierarchy, it's like get yourself ready mentally to like put yourself out there and then try to figure out, what form factor works for you best.
Cool. Yeah. I mean, network, I think, is everything. It's always been there. I view social media as kind of a compounding effect of network.
For sure. Yeah.
And we talked about in, IRL events, in real life. And I think that probably coming back
1,000%.
in a massive way because people want to be more human. They want to meet each other. And I think there's real value in that. And I think there's the amplification of those events than online, right? And I've stayed in touch with people because of social.
Yeah.
I think it's important. Just two questions. Now I'm curious. You're not on social media anymore. You just clipped it out of your life a little bit. What are you consuming today? You just mentioned Substack, podcasts.
Yeah, I probably read. I do consume a lot of content. It's just more one way where I read 50 newsletters every
Okay.
morning. I have my podcast that sort of auto ads like 8 sort of like news-ish type of podcast. And then I have my iPad organized with like, the first thing I go to my iPad and there's probably like 12 apps like organized. Like I go through like BBC, New York Times, Politico, whatever, Business Insider, and just go through that every morning as well. So that's
Okay.
my my sort of content stack there.
So, and I like that. And so if a founder is trying to get your attention, because you guys invest in founders pre-seed, right, before the crowd,
Yeah.
what do they have to do to get your attention?
Oh, they
Right?
just
Can they
email me.
just email you?
Yeah,
Right?
yeah. I'm always I take pretty much any meeting, or at least entertain anybody for sure. Yeah.
So they don't have to write a great post on Substack and then send it.
No, but they can share like if there's other ways to obviously make if they're cold emailing me, it's like, how to make it compelling, and
Mhm.
and it could link to like a LinkedIn post or whatever it might be.
Yeah. And then doing the prep for the show, there's a lot of data around diverse founders consistently outperforming. So like female founders, for example, exit faster. Diverse executives,
Yeah.
executive teams rather outperform their peers.
Yeah.
And yet there's this access gap, right, that you guys talk about, and it's still massive.
Yeah.
Is part of the problem visibility, or are there founders out there just not being seen, or where is that come? Like,
Yeah.
how does that add up?
Yeah, we break it down in three ways: financial capital, social capital, inspiration capital. So financial capital, like not everyone can take the risk of starting a business. Now, I do believe AI allows people to prototype like as a side hustle to see if there's like validation, but money is a real thing. We can't ignore it. So like
Yeah.
there's just number of studies that say people by race, gender, geography, disability, different levels of wealth, right? So like if you have that cushion to make the leap, that's great. But we don't believe
Yeah.
that people should become financial martyrs, right? But in social capital is what we've talked about is like people might not just have the right networks, right? The elite
Yeah.
networks, right? So, but the question then becomes like, you look at HBS, let's just assume the best entrepreneurs go to HBS, which is not true. I mean, plenty of great entrepreneurs, but let's not say it's the only one. But, HBS and their racial and gender demographics don't translate in parallel to VC funding landscapes, right? I don't know what the numbers are, but let's say like the HBS class is 8% black, right? Okay, for VC numbers is 1% black, and then I imagine HBS is like 50% women, or close to it, right? Funding for women is sub 10% with one co-founder, and I think it's like less than 2% for like an all female founding team, right? Don't take my word for all the stats. I'm just sort of,
Sure.
but give or take. So then, like, okay, so social networks is not the only reason sometimes. And then the third one is inspiration capital. And this is something where we think is sort of underappreciated is that, you see what you believe, right? Like I wanted to play tennis when I was younger because Michael Chang played tennis. And I was like, okay, that's what I should play. I'm not going to play any other sport because I see myself in Michael Chang and I play tennis. And it goes similarly, I think, for people and becoming an entrepreneur, right? If they're not see people like them become an entrepreneur, that's going to be a negating factor. It's very also interesting is like, underrepresented people in New York City and SF are more inclined to start a high growth business versus like underrepresented populations we meet in the Midwest or South or any other part of the country. Because, people of color and women and other people's, there's a vibrant tech ecosystem in like New York and SF, but the types of businesses that we see in the Midwest or the South are typically small businesses or service-based businesses or micro businesses. And there's nothing wrong with those. But it's interesting. Our hypothesis is because there aren't robust ecosystems of innovation in like the Midwest and South, people just, again, do what they see. So they don't see the high-tech ecosystem. So then they say, all right, start a small business, which can be also very successful. But people don't strive for that because it's not in their day-to-day life. And so that's what we call inspiration capital.
Yeah, for sure. I mean, I've often talked about this in past shows where starting a business, I think you have to have the inspiration somewhere. And for me, it's my father was also a small business owner, started that, and has always done that, right? He's always done that. So that was my role model and example. Sorry, what?
I was just agreeing. Like that's a great parallel. Yeah, for sure.
Yeah. Yeah. And I think if you don't have that, it's like maybe it's an uncle or an aunt or your mother could be like, I think it's first like that close, who's going to, the people who closest to you in your life are going to inspire you the most. And then there's the people, in social circles or, Rich Dad, Poor Dad. I love that book. His whole thing is like the rich dad down the road versus his poor dad.
Yeah. Yeah.
So
Yeah.
I love that, those three pillars that you've got. It's really spot on.
I just want to add as a disclaimer, like people always assume the worst of small businesses. You can become a multimillionaire through running a quote unquote small business. So I just want to
Yeah.
that. So
I think America is built on small business, right?
Yeah.
The entire economy runs on small business.
For sure. 1,000%.
And I think there's someone, I recently read a post. It was, you're not a small, if you're running a small business, right? You're not a startup, right? Because startup requires capital.
Yeah.
I think that's
it's weird. Yeah, there's too much. Yeah, and people think the only way to make money is through like quote. I mean, startups are small businesses, right? Like every SB, like small business data incorporates startups, right? But it's just as you become an entrepreneur, is trying to understand what type of business you want to run and what type of capital needs you want to go through. Because look, if you could build a company that's valued at $50 million and you own 100% of, that's awesome. Versus like how hard it is to build a VC-backed business, because you have to, most often than not, have to build like $1 billion+ company. That is so hard, so grueling. And small businesses are hard and grueling too, but it's just a different type of expectation. And you might own 1-2% of that, right?
Yeah. I mean, we could do a whole show on that, because there's a lot of founder stories where they did everything right. They did the startup and they raised money, maybe raised too much money.
Yeah.
And then they ended up, selling, and what looked good on paper at the end of the day, like didn't really have that much.
All fake money. Yeah, exactly. Yeah.
Yeah. So we'll have to have you back on. We'll discuss that.
I appreciate what you did with Social Boston Sports. Like you bootstrapped that, you made a real business and you had an exit. Like that's amazing. So.
Right. But it was also a little crazy because thinking about it, I've thought about this a lot, 10 years of your career, and we didn't pay ourselves much, right? Like the first 2 years, I think first year, we paid ourselves like $500 every 2 weeks, whenever, really nothing.
Yeah.
I was also 21.
Different. Yeah, exactly.
And I could eat. I didn't mind, eating, going to Trader Joe's, getting some, 99-cent pasta and whatever. So there was that. We were able to reinvest as much as possible into the business. But then you look back and you're like, compare those two tracks to just jumping into corporate America. Yeah. And I don't think everyone should be an entrepreneur. Like we talked about at the top of the show, that's like a big thing now. I don't think everyone should do it.
Yeah.
But because you can make a lot of money just in corporate America having a regular job. Yeah. And there's zero risk, right? Outside of
risk tolerance, right? Like you can do that at 21 versus, if you have ailing parent or 3 kids or something like that. So
yes,
entrepreneurship is regardless of class, gender, or whatever, it's a big privilege. It is a privilege to be an entrepreneur and to even try. So, and that privilege matters more, like depending on your life circumstances, right? So we talk through with a lot of founders being like, what is your boundary of failure? And we do an exercise being like, and we do 4 different case studies of like different real examples of like when you would quit or quote unquote quit. Because I just hate seeing founders become financially or emotionally devastated by the end of the road. So we try to have these open conversations of like, maybe you were willing to take that risk when you started, when you were 21, but now you have different needs or expectations because you're or whatever, would you quit for them in that way?
It's a great question. Like when do you quit? Do you quit? Right? Like you can't, the saying I love, you can't fail if you don't quit.
Yeah.
But sometimes you gotta like pivot or turn around or
exactly.
Yeah. And it's not always clear, right? You don't always know when to do that. So it's a really interesting thing. All right. So let's jump into the rapid fire round. There's a lot there that we talked about, a lot of great things. This is a fun segment right before we wrap. Some quick rapid fire questions. You can skip if you want. But just keep it quick and we'll run down the list real quick. You ready?
Awesome. Yeah, ready.
All right. So today, what is one brand that you think is doing personal brand better than almost everyone right now?
Oh man, dang. No, quick, rapid fire. No. A good question. I can't think of anything
All
right
right. Next one. What best piece of advice you've ever received about trust?
about trust in general. It's just it starts with you, Yeah, it just you can I'll keep it short like that. It starts with you.
No, that's powerful. I think it's comes from the top, or it starts with you. That's even better. All right. So the biggest myth about VC, what it actually looks like for a founder.
It's not just investing and finding deals. There's so much other sort of responsibilities that I think people aren't aware of.
Okay. I think I know this already, but warm intro or cold outreach is what works best, or is there a place for both?
We try to do best, and we do look at every cold email. Warm intros are always helpful. Back to sort of your point, is like coming from a trusted person. That's always
Yeah.
give us a little interest more.
Got it. Okay. If a founder, in your opinion, and you already said you're off of social media, but if a founder is wanting to get visible, right, build that authority capital and get leverage through media, what's one platform you recommend to them?
Probably LinkedIn at this point. Yeah.
Okay. And then lastly, what is the best book you've recommended the most?
Just Mercy, Brian Stevenson, or A People's History of the United States by Howard Zinn.
Okay. Awesome, man.
Cool. Thank you so much.
Justin, thank you so much for being here. It's been a pleasure. Always good to talk to you.
Thank you for the opportunity.